Should investors buy the dip in DocuSign stock after Q4 earnings? I'm going to answer that question in this video, so stay tuned until the end. What I'm going to do is I'm going to review DocuSign's fourth quarter earnings results. I'm going to look at the big picture results, and then I'm going to answer the question, is DocuSign stock a buy? So let's get right into that review of DocuSign's fourth quarter earnings. Revenue increased by 14% in Q4 to 659.6 million. Earnings per share of 2 cents was a huge improvement from a loss per share of 15 cents in the same quarter last year. Now remember, the market is increasingly focused on companies that can deliver profitable growth. The market is no longer interested in this growth at all cost type of companies, and you've seen a lot of growth stocks lose a significant share of their valuation as a result of not being profitable on the bottom line. Billings of 739 million was a 10% increase year over year. Billings are contracts that DocuSign has signed with clients that have yet to turn into revenue, but they will turn into revenue. So, for instance, if DocuSign signs a contract with a client that says, okay, we'll sell you 1,000 e-signatures for, I don't know, $1 million, right? DocuSign records that 1 million as billings. And then as those signatures get executed, then it becomes revenue, right? So first it records the deal as billings, and then the billings turn into revenue as DocuSign delivers the service, okay? So that's why billings are important, because they eventually turn into revenue. Free cash flow of 113 million was much higher than the 70.3 million in Q4 of 2022. So profits are growing, cash flow is growing. Excellent. I love to see that. And so you might ask, okay, revenue grew double digits. The company turned around from a loss per share last year to a profit per share, and it increased free cash flow by 40 million from the same quarter the year before. So why was the stock down nearly 20% on the day after it announced these earnings results? And that's likely due to the forecast. So the company's forecasting 2024 revenue of 2.7 billion. Q1 revenue of 641 million. So if it achieves this 2024 revenue forecast, that would be a less than 10% increase from the 2.5 billion in 2023. So they would go from 19% revenue growth in 2022 down to less than 10% revenue growth in 2023. So that revenue deceleration was what investors were not happy to look at in this fourth quarter earnings report. So along with the fourth quarter earnings announcement, the company gave an outlook for their fiscal year 2024, and that outlook, that forecast, is what disappointed investors and why the stock price was down, right? If you look at the actual fourth quarter results, they were good. They were really good. But what was disappointing was the forecast for 2024. Now, I say disappointing to the market. For me, I was not that disappointed in this forecast. I was not that disappointed in this forecast because I see the company is focusing on profitable growth and not just growth, right? So to see revenue growth slow down, I'm okay with that because I'm seeing earnings per share when there used to be a loss per share in Q4. I'm seeing free cash flow grow by 40 million year over year to 113 million from 70 million, and I'm seeing a similar outlook for 2024. I'm seeing an outlook, let me pull this up for you right now. The outlook for fiscal year 2024 for operating margin is 22% operating profit margin. So an excellent operating profit margin forecast for 2024. So I'm out, and if you've been following my videos and my channel, you know that I'm a favor of profitable growth, of if it's necessary to grow your revenue slower in order to grow with profits, right? Don't just go all out into looking at revenue growth. Focus on growing sustainably, profitably with positive free cash flow. Take your time. Build your business on a sound, sustainable foundation. Don't just try and explode all at once, right? Don't be the get rich quick of corporations, right? That's not my style of investing. I'm not attracted to those kinds of growth stocks. So for me, I wasn't too disappointed in this outlook. Now, the stock price fell nearly 20% following the earnings results, but it recovered on the day after that. So on the second day, the stock price rebounded. So that's why you see I have here pulled up a forward price to earnings chart of DocuSign. Before the earnings announcement, the stock was trading at a forward PE of 24. That fell all the way close to 18 and a half, but that rebounded back to 19.9. So the stock is now trading at a forward price to earnings ratio of 19.9, where it used to be trading at a forward price to earnings ratio of 24. So this already takes into account the expectations for its fiscal 2024. It's looking ahead 1 year. It's looking ahead 1 year at the earnings 1 year from now. Okay, so DocuSign was and still is actually one of my top stocks to buy for 2023, and it was one of my top growth stocks to buy for March. And I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So after these earnings results, I'm reiterating that recommendation. I still think DocuSign stock is a buy. And to answer the question, should investors buy the dip in DocuSign stock right now? I would say yes. I would say yes. Yes, you can expect growth rates to slow down, but that's okay if they're doing that profitably. If they continue to demonstrate to me these improvements, these huge improvements in profitability, in free cash flow, I'm okay with slower revenue growth. In fact, I would prefer that slower revenue growth and higher earnings and higher profitability, especially for a company like DocuSign whose total addressable market is not that big. You know, the market size for e-signatures, depending on which estimates you look at, is around $50 billion. So it's not like some massive trillion-dollar market opportunity where you want to quickly grow into that opportunity and scale up quickly because that will help you achieve profits. This isn't that type of a market. So you're not going to scale quickly and reach profitability by scale economies, right? So in this type of market where it's smaller, I would much prefer slower growth, more profitable growth with better free cash flow generation. All right, so that's all I've got for this video. As always, I truly appreciate your viewership. If you like this video, I'm going to link you to a couple of other videos at the end of this one that I think you'll enjoy. So please click on one of those and I'll see you over there.